Hi everyone, I'm Rohit Yadav, and today we are covering venture asset class from a very strategic perspective while taking a secondaries lens. As venture capital navigates a pivotal phase, the future of the asset class remains a top strategic priority for us all to answer. And that's why I'm on this journey to unravel the different forces impacting the ecosystem, including the rise of secondaries, the private markets, and the asset classes like venture capital, and how we all, as investors, founders, and ecosystem players, should make sense of it. And to do this, I have the perfect guest with me today, Rando Rannus. Thank you for joining us, Rando. Rando's journey is super interesting. So, from consulting in 2000s to building and successfully exiting his own startup in 2010s. And now he has started in the last 5 years. He's focusing on building one of the first dedicated VC secondary funds in the CEE region. So his focus is quite niche. And we want to capture his thoughts on the secondaries market in Europe specifically. So, Rando, can you introduce Siena to us all?
Thanks for having us. You wrapped my history quite well, but I'm not alone in Siena. And I joined a team with two other GPs who have 25 plus years in investment banking and tech-enabled investments. They launched one of the first VC funds in the Baltics in early 2000s, which invested into the social network before Facebook was born. And over the years have done a lot of activities and other kind of buy and build strategies, etc. But why I joined and why we kind of took the challenge of building the firm is that we saw the same thing happening in the market. Estonia, which is quite famous for building unicorns, we're kind of fighting with Israel, who has the most unicorns per capita in the world. We saw that the early stage was getting already quite crowded because the money influx internally and also from internationally was quite high, and it was hard to even get into the best companies ourselves. Plus, the valuation started to climb already to the level of US companies. At the same time, at the late stage scale ups, in those cases, some of the local investors had done well.
Mhm.
They have invested in early stage, but they were locked there and they was started to seek for some liquidity. So back in 2018 already, we did one of the first secondaries in Bolt, the ride-hailing unicorn,
Okay.
and as a standalone kind of syndicate. And one thing led to another, basically, and we decided that, okay, maybe it's time to have it more institutional. So in 2021, we launched the dedicated VC secondary fund. That's what we do.
Okay. And so it's amazing journey. Where do you stand right now with respect to investments, your portfolio, and what's your vision for the next 3 to 5 years? Obviously, you must have discussed the vision, right?
Yeah. So just to clarify, where we focus. So one thing is that geographical focus. We focus on the scale-ups originating from the centuries in Europe, with a slight touch with Nordics as well. Originating means that the founders or the tech teams are usually coming from the region.
Okay.
And but the companies are usually global companies. I mean, mentioned already Bolt, Booksy from Poland, Aura Ring from Finland, etc. But the what we're looking at is the kind of a company level secondary. So we are not going into the LP stakes or portfolios or anything like that, or continuation funds for GPs. This is something that we're keeping away. The reasoning is that I think the market is not ready for that because the generation, I mean, at the moment, probably in the second generation of VC funds, in some cases, third generation. And the first generation of funds that were created back in the early teens were backed by mostly by single LPs, either
Okay.
EIF or local government fund of funds. You don't have this kind of a long LP cap table there, which are in need of having some liquidity. We see that this is happening now. It started to happen in kind of a late 2010s or early 20s. So probably, I think this will be something that we will start to look at in, let's say, 3 to 5 years when the funds have matured The
Okay.
assets have matured there, and then we're ready to look at this. But at the
Okay.
moment, we're focusing only on the company level secondaries, on the kind of scale ups from the region, category leaders. Revenue wise, we're looking at companies that are at least 10 million annual revenue, growing 50% or faster, valuation 100 million plus. So true scale ups. And and ticket wise, we are allocating 1 to 5 million. So we are focusing on the mid market and not going into the really small deals like 100,000. And we're not going into the 10 million plus deals where large international funds like industry ventures, G Squared, the Stepstones, or investment banks like
Yeah.
Goldman Sachs can come in. The mid market is quite empty. And this is extremely suitable for the counterparts with whom we are interacting. These
Okay.
are mostly founders, early
Mhm.
employees, and angels. So our counterparts most likely will not be the other GPs. They can be sometimes, but in a priority list, I would say that they're probably lowest.
Okay.
And this is probably because of the reason that if the GPs have kind of done a home run, so they want to keep the asset as long as possible.
Yeah.
It's changing now in the last 2 years, and the GPs are now really considering how to deliver some TPI to their LPs as well. But historically, they rather keep the best assets as long as possible.
Loved your answer. It was super elaborative and it touched on multiple points. Maybe one step higher, if you can explain different type of secondaries very briefly. So there's one company level, there could be GP level as well as LP level secondaries. And how do you see this three different buckets in context of Europe, which is most developed? And I think you touched upon it a little bit, maybe more focused on this topic of these three buckets.
So if you look at the kind of a historical background where the secondaries have started out, they started out from the private equity side.
Yeah.
And so anyway, I mean, we are focusing now on the venture capital backed assets, and this is already something new that the large firms who are have been allocating for the private equity funds, like I mentioned, the Stepstones,
Yeah.
Lexingtons, whatever, and the likes. So they haven't looked at that part so much, but now as the market is evolving, I mean, the kind of new success stories were in Europe started
Yeah.
out in the early 80s. I mean, Wise, Revolut, Vinted, etc. They started out 10, 15 years ago. And now these are kind of maturing. The kind of market is evolving in Europe. And I think the real need for the liquidity has become important over the last 5 years. It wasn't the case before
Okay.
because the market wasn't big enough. Just to illustrate, I mean, if we look at only the Central Eastern Europe, then the market cap of startups here is roughly 100 billion, and the liquidity need is estimated 2 to 3% per annum.
Hmm.
So it's a 2 3 billion opportunity in itself only in the Central Eastern Europe. If we now extrapolate this to the whole Europe, then it's many times bigger. So it's definitely something that we could say that Europe is kind of following the steps that US has done
Okay.
already 25 years ago, but it just takes time. And of course, the large firms will step in, like I mentioned, but they most likely will continue the playbook that they have done it before. So they rather focus on the portfolios, LP stakes, etc. And on the other side, there will be the niche players who are more focusing on the single assets. These are like us and some other a couple of players in Europe.
What you're saying is this existence of company level secondaries existed for a very long time. Obviously, Europe is following the US steps, but this GP and the LP secondaries topic is actually very new, right? So this is all in the last couple of years when everyone struggled with the DPI issues that GPs and LPs started to thinking about how can we unload some of those stakes in the secondaries market and get the capital back, right? So I would say in terms of development, and you can correct me if I'm wrong, the company side of secondaries has existed for a very long time because of employees, because of angels who wanted to get out of the solid deals and so on. But the GP and the LP side is rather new.
I would say that the what is important is that how the mentality has changed over the years. And this is not only in Europe, but it's also in US. 10 years ago, it wasn't favored if a founder sells before the final exit. And I think over the last now 10, 15 years, it has started to change both in the US and also in the Europe, that it's okay to sell and take some chips off the table if the company has done well. Many investors have said that this helps to basically bring the risk appetite of the founder and the investor at the same level. So that if you have like 1, 2 million taken off the table, then you can continue and take the risk and then build the company as you wish. So I think that that's important kind of a cultural shift
Okay,
that has happened, which has also then supported the whole growth of the market.
got it. And so now I want to shift to the journal asset class level discussion of the secondaries. And I want to focus on the LP side. So an LP who wants to invest in a secondaries fund like yours, how is this an attractive bet for them? And you can talk about the asset class specific, the returns, and so on.
So I mean, traditionally, if you look at the VC, how to invest into VCs, then the majority of the money went to the early stage. And the early stage VCs, their kind of a promise was that we are good investors. We have either invested before or we have exited some companies. So we know how to pick the best rocket ships for the future. But in reality, it was like a Forrest Gump story, box of
Mhm.
chocolates, and you never know what you're going to get from there. And if you now look at what the secondaries are bringing along, it's basically giving a transparency on the target list, because
Okay.
it's not something that it's a big in a bag. So you know what you're going to get most likely, what type of companies the fund manager is going after. And I think that's the one thing that has helped to attract some of the new LPs into the asset class. For example, in our fund one, half of the LPs were new to the VC and startup investments, half of it.
Wow.
So this was the first time they got investment product where they felt comfortable to invest into the high risk environment. But if you look at the historical returns, then it's not so high risk. The early stage funds, there are a quarter of the funds who will not deliver 1x.
Hmm.
So 25% will not deliver the 1x money back, and only
Maybe even
10% of
more.
the and 10% of the funds will then try the real return. So it's a power law also in selecting the best fund managers. So on the other hand, if you look at the secondary fund managers, then historically only 1% of funds have not delivered X. So the downside risk is much lower, and take into account that the fund lifetime is shorter. In our case, it's 7 years. In early stage VCs, it's 10, 12 years. The return profile is also similar to the early stage, because we're not holding the assets so long. We are getting into the companies with a discount. So all these kind of aspects combined, we can deliver also similar return profile as the early stage manager. So talking about 20, 25% IRR is
Okay.
totally normal for the secondaries fund as well.
And if you can explain the growth within this middle segment, as you mentioned earlier, in Europe, and there's a gap that you see, and that's why you're building Siena. How is this gap getting filled up with secondary funds coming up? And why aren't, let's say, the bigger players in the secondaries market not focusing on the middle segment?
It's a good question. I don't know why the managers in Europe haven't went so much into the secondaries. And so what you're seeing now is that in different parts of the Europe, there are new fund managers popping up. For example, we in Estonia, there's one Danish fund. There is in Switzerland called the Giano Capital. So there are a few funds who are popping up across Europe. But what we can see, what's happening on the other side of the ocean in the US, is that some of the larger funds
Yeah.
have now legally restructured themselves, for example, Sequoia, Axel, etc. And why they have legally now restructured themselves is exactly because they want to have the ability to invest more into the secondaries. So,
Okay.
and this you will probably start to see in the coming years as well, that the large U.S. funds will probably put some bets on the top names in the industry, either within their portfolio or outside as well.
Outside the Okay, so it's a perfect segue into the next question that we are focusing on the journal asset class of secondaries. What are the trends specific to secondaries that you see in the next 2, 3 years? One, you mentioned right now that the bigger funds are changing their structure and trying to focus more on secondaries. Do you see other LP, GP, geographical trends that are coming up?
Well, one thing what I see at the moment happening, and that is already a reality, and this might continue as well, is that the secondaries market is in, I would say, a two-sided coin. At one side, you have the top names in the industry, Stripe, SpaceX, OpenAI, whatever, where you have large tenders happening with a premium to the last round. And you see there is a huge demand in getting into those companies. And then you have the rest of the market where you don't see the premiums. It's usually still with the discounts.
Hmm.
And if you do your homework well, you can find really good assets there.
Okay.
So that's why, I mean, why we are focusing on the Central Eastern Europe is that there's no liquidity providers here, and this enables us to kind of tap into the opportunities locally and get the best returns if it's possible. But that's what I see, that it's so the market is not like unified. There's like definitely kind of two different kind of sides that are happening,
Okay.
and both can deliver interesting cases for investments.
If I have to talk about secondaries AUM, assets under management for Europe, do you see it growing much more than the VC AUM? Do you, in your talks with the LPs, do you see much more enthusiasm from LPs for secondaries than VC GPs?
A good question. I don't know that
Okay.
on a Europe level. What I see that the secondaries market as such is growing. Last year it was 120 billion across the world, and it's growing roughly 15-20% per year, and this will definitely continue to grow over the years. So like I said, there are like two things that are affecting this. One thing is that you have those really top names that are
Mhm.
attracting the capital. Everybody wants to get there. Everybody wants to allocate as much as possible. And then you have the kind of the rest of the assets where LPs, GPs, or founders are seeking for liquidity. And if the IPOs the market is not ready, if you don't have M&A opportunities, you try to kind of offload it through kind of secondary markets. So that's definitely two sides that kind of help to fuel the market growth in both sides.
Got
And
it. Okay.
over the last 2 years, if you look at which funds have managed to raise the most, then these are secondary funds.
Billions of AUM, right, raised in one single fund for secondaries like Sepstone and others as well, right? Industry is also in the market. So yes, definitely from that side. And I think it makes sense for them as well because secondaries is much more uh, developed product within the firms which are doing that. So they know how to do it, they know how to capture it. And because the brand name is so concentrated within those few names that they're able to do that. They're able to scale up their AUM quite a lot. Yeah. I want to move to your strategy and talk about CEE region in general. How do you see Nordics, Baltics, and so on? Can you define or map for the audience the size, the growth, the players? You say there's already not much happening in terms of liquidity, but still, if you can talk about some of the deals that you saw last year, something that you're seeing this year in context of secondaries, that would be nice.
Well, like I mentioned before, only in the centuries in Europe, the whole market cap for the startups is roughly 100 billion. And then the kind of need for liquidity should be at least 2-3 billion. And thus, there are not so many liquidity providers. The LPs, the GPs, the founders are looking for different ways. If it's kind of a, let's say, top-notch company, either in AI or any other way, kind of growing and building the kind of category leader status, then you will see strong demand for that. I mean, for example, 11 Labs from Poland, the AI company Vinted, which just did a tender offer for a few hundred millions. It was oversubscribed. So, and again, with a premium pricing to the last round. So you will see such kind of things happening. And then at the same time, you have other companies that are waiting for the market to solve its case itself. I mean, for example, in our portfolio, Bolt is a really strong company,
Okay.
and you see almost every month activity in the secondary market happening. Somebody selling, somebody buying. Prices are quarter by quarter in the secondary market growing, which is good. But the company is like still waiting at the right time when to go to the IPO. So and everybody waiting. Once there will be an IPO, I think everybody will be happy. Still, it's not the right time, and everybody waiting for this.
Okay. You mentioned a couple of times there is a huge divide when it comes to few company names getting much more traction in terms of secondary volume, secondary interest from the market participants. And then there's the rest of the market, right? Where their secondary price is actually on a discount rather. Did you see this getting solved? First, the first question to ask is, do you think this is the right setup of the market, that it should be this ways? And second, if not, then do you see it getting solved? And maybe if you can tell us a couple of the reasons why this is happening right now, because there are not, supply versus demand issue or XYZ.
Well, no, I don't think it's the right situation. I think the investors who are just pouring into the
Yeah.
asset class with premiums and no, I don't think that that's the right way. I still believe that the secondaries should be with a discount because it provides the liquidity. It provides you're not buying usually the kind of the highest preference stack. So there are several reasons why it's like it should be with discount. But at the same time, I mean, what I want to emphasize is that on the other hand, in those kind of rest of the companies, there are so many interesting cases that if you kind of pick them well, there's a quite a big upside potential. That's important that to kind of focus and take into account.
What you're saying is the market is not set up well in terms of which company is getting more tractions versus which is not. And it could be due to multiple reasons: branding, lack of knowledge about a specific company or such. And therein lies the alpha for funds like yourself, who can capture the opportunity which others are not seeing in the market, right? So although it's not the best situation, but this situation is leading to the alpha.
Think with common sense, is it logical that you focus only on 20 companies in the world? Probably not. I think, well, if you have thousands of companies, there
Mhm.
are definitely a lot of good assets if you do your homework well and find those assets. Just to give you an example, I mean, I mentioned the Bolt. I mean, we did our internal analysis
Okay.
and the fair market value could be already higher than the last round valuation. But we still see transactions happening with significant discount to the last round, and
Okay.
so you can build already quite a nice kind of arbitrage already on that side.
Awesome. Understood. And now I want to focus on the deal making aspect for you, for example. What are the complexities that you see or typical issues that you see during secondary transaction? Is it because the deals are complex? Is it because the quality of the deals that you are seeing in the market? Is it the negotiation part? Is it the discussion about bid versus ask kind of spread of the discount on which it's being offered? So if you can map all those kind of characteristics of a typical deal, that would be nice.
Well, the most important, I would say, I mean, assuming that you have a quality target, I mean,
Mhm.
then getting access to the information. So if you
Okay.
don't have access to the information, you shouldn't make the deals. And what we're seeing is that some investors still are doing it. So it resembles a bit of 2021
Uh-huh.
activity, especially again, investing into those AI type of companies. You go into the syndicate, which invests into syndicate, which invests in the
That's
syndicate.
indicate.
I
Okay.
don't think that's a right way of doing. So having access to the information and being in touch with the
Mhm.
management, working together with them, being, I mean, welcomed on the cap table, that's really important. So not to do the blind bets, as it was done in a couple of years ago. So yeah, that's I think the most important thing what to follow.
And how do you see the aspect of risk mitigation? So you mentioned it nicely that having a relationship, not relationship, but having an understanding with the management team, having enough information. Um, how do you mitigate risk within a deal itself, apart from the couple of topics that you mentioned right now?
Getting, I mean, one thing is that you need to be comfortable with investment and you're getting access to the data. You understand where you're getting into. So
Okay.
that's important. So you need to understand the company, the growth trajectory. You need to understand the cap table. What are the preference stacks there? What
Yeah.
share class you are buying, and how the future will look like. What is the board dynamics? Who is kind of in charge there? Who is driving the exit strategy? All these questions are important. If I'm thinking now on the kind of a context of deal structuring, there are like different ways how to mitigate some of the risk as well. It's not always needed, but for
Okay.
example, we have done deals where we know that the new round is coming up, but we want to close the deal now. Okay, let's close the deal now, and then kind of have some adjustment mechanism if the new pricing point will be agreed. So different things can be agreed. Also, what is could be agreed is some downside risk protection, or then sharing some upside if things go well. These things can happen. Of course, the easier is to just to agree plain vanilla discount to the last round. Then that's easier, especially when the last round was happening within the last 12 months. Sometimes it's needed to kind of meet the middle ground with the seller and kind of share the risk and rewards with both sides.
Last question from my side. What is the total number of portfolio companies that you envision within the Siena fund?
In the fund one, we have 10 companies. And now in the fund two, we plan to have 15. We are rather concentrated in our portfolio
Okay.
compared to the early stage. But like I said, I think the kind of a secondary fund in its investment logic is more kind of more, let's say, growth equity type of investing because we already see the numbers and where the company is heading. So the kind of phase wise, we are much later, and that's why yeah, we need to kind of have more concentrated bets, and once we see that the company is doing, we are happy to double down on them. Like I have already mentioned, Bolt is one of the good companies in our portfolio. Over the last 4 years we have invested every year into the company, so this shows that our conviction that the company is doing well. If there is a good kind of a case available, why not to use it.
Absolutely loved your analysis on why a concentrated approach makes much more sense in a secondary fund like yours. Rando, thank you so much for joining us and shining light on all those different aspects of secondaries, and especially in context to CE region where there's a big gap, as you mentioned. And best of luck to what you're building. I think it's needed, and not just for liquidity purpose, but also building for building maturity of the whole ecosystem, right? So kudos to what you're doing, and all the best for your journey. Thank you so much, Rando.